Picture this. It's a Tuesday night. You're sitting on your couch, scrolling through your banking app, and you're looking at a balance of, say, $10,000. You're feeling pretty responsible, right? I mean, you did the hard part. You went to work, you saved the money. But what if I told you there's an invisible drain quietly siphoning off your hard-earned cash while you sleep? Well, welcome to this explainer. Today, our mission is simple. We're going to turn that financial fog into total clarity. We are breaking down 5 very specific secrets that wealthy people use to actually profit from inflation.
Look, here's the stark reality. If inflation sits at 4.2%, that standard bank account you were just looking at didn't just securely hold your cash, it silently lost $420 of purchasing power. Poof, gone. You're not going to see that transaction on your statement, but the loss in what that money can actually buy out in the real world is painfully real. Most people just watch this happen and feel totally helpless, assuming rising prices are, just some unavoidable law of physics.
But this brings us to a massive psychological shift. See, the average mindset looks at the economy and says, man, goods are getting more expensive. The wealthy mindset, on the other hand, says, currency is getting weaker. We call this the monetary expansion illusion. Think about it for a second. A dozen eggs or a physical house hasn't actually changed its utility in the last 5 years. It does the exact same thing it always did. What actually changed is the paper currency we use to measure it. When central banks expand the money supply, you just have more dollars chasing the exact same pool of physical stuff, completely diluting the purchasing power of every single dollar in existence.
Okay, let's dive right into phase 1, the physical world. Think back to 25 years ago. The average U.S. home costs somewhere around $160,000. Today, national medians are hovering well above $400,000. Major real estate moguls built absolute empires on a very simple principle. When inflation hits, the cost of building materials, labor, and land values all rise in tandem. So if you own tangible real estate, inflation essentially inflates the nominal value of your property, which rapidly expands your balance sheet. Meanwhile, your renters are the ones actually absorbing those rising nominal costs through higher lease payments. Moving right along to phase 2, flipping the script, or as the pros call it, asset-backed debt.
Now, I know this sounds completely backward, mostly because we all suffer from a behavioral mental trap where we're taught that absolutely all debt is inherently bad. And sure, a high-interest credit card at 20%, that's a financial mosquito, absolutely bad. But fixed-rate debt during high inflation, that unlocks something called devaluation arbitrage. High-net-worth individuals rarely sell off massive chunks of stock to buy things because, well, selling triggers capital gains taxes. Instead, they pledge their appreciating stock portfolios as collateral for low-interest personal loans, and then they spend that loan capital today on appreciating assets.
So how exactly does this engine room work? Let's walk through the math real quick. Step 1. You lock in a long-term loan at a 3% fixed rate. Step 2. Inflation runs at, say, 4%. Step 3. You repay the loan later with weaker dollars. Think about that. The bank handed you strong dollars today, and you are paying them back with weakened dollars tomorrow. The real value of the loan actually shrinks every single year, all while your underlying stock continues to compound.
Real quick, if you are finding this breakdown of macroeconomic systems helpful, and you're enjoying turning all that financial fog into total clarity, take 1 second right now to smash the like and subscribe buttons. It seriously helps this explainer reach more focused learners just like you.
All right, back to it. Phase 3, the trust gauges. Here, we're looking specifically at gold and Bitcoin. These are assets that act as defensive scarcity plays when global trust in fiat currency starts to crack. The crucial difference really comes down to utility. Gold has performed a single job for thousands of years. While the US dollar has lost literally over 90% of its purchasing power over the last century, gold has expanded significantly in dollar terms since the 1970s. Legendary macro hedge fund manager Ray Dalio keeps a dedicated allocation of gold in his all-weather portfolios, specifically as insurance against government money printing. But here's the catch, guys. Gold is a passive asset. It just sits in a safe. It doesn't pay dividends like stocks. It doesn't generate monthly rent. It doesn't generate wealth. It simply protects it.
And that brings us to the modern digital variant of the gold thesis. During that massive central bank stimulus back in early 2020, billionaire hedge fund trader Paul Tudor Jones famously allocated a portion of his fund to Bitcoin, literally calling it the fastest horse in the race against great monetary inflation.
Let's break down his mathematical logic here. The biggest pro? A fixed supply. Only 21 million Bitcoins will ever exist. It's coded directly into the protocol. Unlike fiat currency, no central bank can just decide to print more of it to fund their deficits.
The con, obviously, is the intense volatility. I mean, it frequently suffers 40 to 50% drawdowns, and that is exactly why sophisticated traders treat it as a high-upside, small percentage allocation rather than a primary, stable store of value.
Which brings us to Phase 4, the ultimate moat, productive equities. This right here is what legendary investor Warren Buffett considers the absolute ultimate inflation hedge. It brilliantly illustrates the concept of the pricing power moat. Buffett said, the best business to own during inflation is one that can raise prices without losing customers. Back in 1972, right before one of the worst inflationary decades in modern history, Buffett purchased See's Candies. And guess what? Every single year as inflation rose, See's Candies raised the price of its chocolates, and their loyal customers just kept paying without hesitation. The whole goal here is to switch sides. When consumer prices go up across the entire economy, elite companies, whether they're selling iPhones or coffee or enterprise software, they simply raise their retail prices. The revenues rise right alongside inflation, basically passing the cost directly on to the consumer. As a shareholder, you've switched sides in the economic game. Instead of being victimized by rising prices, you actually collect a slice of that higher revenue.
All right, welcome to the dashboard, your 5-point action plan. Let's bring all these concepts together into some clear, actionable takeaways.
Across all these strategies, the core principle is dead simple. Shift out of cash and hold productive assets. You essentially have 5 powerful levers you can pull. 1. Real estate as a tangible store of value. 2. Asset-backed debt for that sweet devaluation arbitrage. 3. Gold for systemic trust. 4. Bitcoin for digital scarcity. And 5. Productive equities for absolute pricing power. And honestly, the best part? You don't need to be a financial wizard to play this game anymore. Thanks to modern fractional shares and low-cost index funds, literally anyone can start buying a piece of the world's best businesses for the price of a pizza.
So, that brings me to a question for you guys. Which of these 5 methods do you rely on most to beat inflation? Are you heavy in real estate, index funds, precious metals? Let me know down in the comments below. If this explainer successfully cleared up some of that financial fog for you today, be sure to hit that like button, subscribe, and maybe share this with someone who really needs to protect their hard-earned cash. Stay curious, stay focused, and keep learning.